On today's Hashi, I'm discussing the PPI, Producer Price Index. So, inflation data for August, a delistings surge as the U.S. housing market reaches 5 months' supply, and mortgage applications for the past week. Today is Wednesday, September 10, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Connecticut. Let me know in the live chat which market you are tuning in from here. We're wrapping this week today, Haley. I don't know if you know this. I've got a little travel conflict tomorrow morning. Going to be on a flight. There won't be a Hashi. I know. I'm sorry. I hate doing it myself, but there won't be a hot sheet tomorrow morning. So we're going to wrap here, but we have inflation and we have mortgage applications. So bunch to get into here. PPI, Producer Price Index, as we look at inflation now leading into next week's Fed meeting. Remember, the Fed's more focused right now, it appears, on labor. It's a Logan Mohtashami quote. Hey, labor over inflation. But we know that over the last 2-3 years before we got here to this labor conversation over the past, couple of months, it's been all inflation talk. So we're still looking at this data coming in. There's still uncertainty on inflation overall as it relates to tariffs, trade deals, and the like. So Producer Price Index, which just was released this morning from the Bureau of Labor Statistics, comes in actually down 0.1% in August. Okay, so if we look at August edging down 0.1%, that beats expectations. Okay, so check mark, good column on PPI, this particular inflation report, which, listen, this isn't PCE, which is the Fed's favorite target. It's not CPI, which is the market's favorite target. It's just like, it's the bologna between the two pieces of bread. It's kind of a bunch of bologna, but it's something we got to look at. And 0.1% down in August is a win column for where inflation is heading. Okay, good. Check there. Final demand prices advanced 0.7% in July and 0.1% in June. The August decrease in final demand index is attributable to a 2% decline in prices for final demand services. So these are good numbers on in particular what's happening here in August. The headline from CNBC says these prices unexpectedly declined. Okay, we've got the Fed meeting next week. And is this going to be, a key point for Jerome Powell to use, saying, hey, we're actually not seeing inflation in respect to all the scare tactics Jay Powell used a couple of months ago, saying we don't know about inflation. It could get out of control. Lots of uncertainty. Tariffs are bad. Trade deals bad. Is there going to be an acknowledgement there that, hey, inflation's actually not doing all that bad? And we're actually seeing some signals like here at PPI where it's going down more than we expected. And we got to really focus in on jobs, and we got to do multiple cuts to protect that side. That's what the market's looking for. Is he going to say we got to do multiple cuts? We know there's a cut coming next week. Question is it going to be 25 basis points or 50? Markets are leaning more towards 25. I think 50 would be a little bit of a surprise, but it's about the future. How many cuts are we going to get in the future? And is there going to be an acknowledgement that, inflation not doing all that bad? This CNBC article points out that the August was more than expected. Okay, so also there was a downwardly revised July number. Okay, so July on the revision downwardly revised. Dow Jones estimate was 0.3 versus the 0.1 that actually came in. So the key point here that CNBC is making is this morning's release on inflation provides breathing room for the Federal Reserve to approve an interest rate cut at its meeting next week. Liz, I think the Fed is suffocating. I don't think they have the breathing room um, in regards to where the labor market is, right? So I think they're getting choked out from all angles. There's division within the committee. There is pressure with the job reports. There's a certain group of people looking at the Fed saying you're being political. I know a lot of people disagree with that, but it's pretty hard to disagree with the fact that Jay Powell himself called inflation transitory for months when it was obviously not. And only when the last president reappointed him was it then 8 days later that he said, oh, no, wait a minute. It's not transitory. Let's get working to fix it. So these guys, both sides of the aisle, the whole deal, the Trump cabinet, the last cabinet with President Biden, certainly Jerome Powell, they're all playing their own game. They're all playing politics. And unfortunately, the Fed is no different. They are now a political divisive group, the way I think many that are taking an objective and non-emotional viewpoint of the Fed. And the markets do serve the markets serve a much better barometer of setting these rates than the Fed anyways. The Fed just stamps what the market is doing. The market is calling for cuts. The Fed's going to point that out. Service prices, a key metric for the Fed when evaluating the stance of monetary policy, that posted a 0.2% drop wrapped up into this PPI number here. So inflation getting better, not worse. Tariffs have not destroyed the markets. Certainly they're all at all-time highs, and has certainly not produced a runaway inflation scenario. Some would argue that it's still too early to decide that. But if you look at PPI here, August going down, and that beats expectations, and we are showing now a couple of years of consistent improvement here on inflation as it relates to the PPI status. Now, if we look back onto the report here, there is a if we go to core PPI for the 12 months ended in August, the index for final demand less food energy trades moved up 2.8%, trying to get everything down to that pull a number out of the sky, number that the Fed has of 2% that came from New Zealand. I don't know what New Zealand has to do with anything, but came from there decades ago. This is the largest 12-month advance since climbing to 3.5% in March 2025. So 2.8 based on some of the last couple of months probably being factored in. And then March was the last 12-month high number at 3.5. We're at 2.8. So still trending right direction, and on a monthly basis, better than expected. There's your inflation report for today. Today's news with the PPI. Okay. Realtor.com, straight from their media room, reports that 7 of the 50 largest metros, U.S. metros right now, are buyer markets. Okay. So the official flip from an equilibrium market, which you could say is the rule of thumb over the years has been 6 months of inventory in a market. Neither buyers nor sellers have the leverage, the control in the market. 6 months of inventory, a state of equilibrium. What Realtor.com says in their practice, the metric is a longstanding rule of thumb. Fewer than 4 months, sellers market 4 to 6 months is balanced, and 6+ months favors buyers. Okay. So, and, certainly if your market's more transitory and there's a higher rate of moves, I think you'd probably lean towards the Realtor.com number. I've gone more of 6 months being the equal, under 6 sellers, over 6 buyers, based on, the market, up in New England and the Northeast states, things move a little more old school. Okay. Some of these town halls up here, when you walk into them, they're still signing documents with a feather on the pen. So things just move a little bit differently here, and people stay in their homes longer and all of that. So I like 6 months, but you may be, hey, I'm in Vegas, baby, and it's, fewer than 4 would be sellers, but 4 to 6 is equal and over 6 is buyers. This is the way realtor.com looks at it, probably more accurate. Right now, realtor.com's August monthly housing report is showing months of supply at 5 months. That's above the NAR number. It's the highest we've seen, a level not seen in the summer months since realtor.com began tracking the metric back in 2016. And if they were tracking in 9, 10, 11, and 12, they would have seen this number, surpass 5 months of supply. But when they're looking at the summer months, and they're tracking since 2016, this is the highest they've seen months of supply since that time frame. Okay, this shift continues to signal the continuation of a slow rebalancing in favor of home buyers. So 4 to 6 months being the equilibrium, the balanced market, as Realtor.com puts it. If we're at 5, we're smack dab in the middle of a balanced market across the U.S. Okay, now transactions have been absolutely suppressed. But when you look at like the market from a buyer/seller perspective, neither is happy, which means we're closer to balance than we've been in many years. Okay. Here's also some numbers out of this August 25 housing metric report from realtor.com. They've got a median listing price right now listing at $429,990. So just under 430,000 for August 25. That's on the list side, realtor.com, lots of data. Change over July 2025. That's a 2.2% drop month over month. If we go year over year, it's flat. And then if we go from August 19, we're up 36.2% on median list price. Okay. Active listings, according to RDC, realtor.com, is just under 1.1 million. Month over month change is down 0.4%. Remember, August, we lost active listings. Altos supports that, which is interesting because usually you don't see that decline till later in the year. We're going to be watching closely, and certainly Monday is going to be an interesting show when we do the hot sheet and we look, a week now after holiday week, do we gain any inventory back? Sellers are just not impressed with what this market is offering. Hey, there's more balance, and sellers got to come to grips with that. They don't have the leverage. The pendulum has shifted back towards the middle. And you actually saw listings come off the market where sellers saying, I don't have to sell, so I won't. 0.4% down July to August, 20.9% up if you look at last August, though. So when you stretch that out over 12 months, many more options on the market. Change over August 2019, still 11% down nationally on active listings versus August of 2019, that pre-pandemic August there. New listings coming in 7.5% down since July, 4.9% year over year up, and down 16% when you look at August 2019. Okay, so not all the way back nationally to 2019 levels. Median days on market is 60. That's up 2 from July. That's up 7 from last August, and only up 1 from August 2019. 20.3% active listings with price reductions. Okay, so 7 of the largest 50 U.S. metros mentioned before were in buyer market territory. Here they are: Miami, Austin, Orlando. Okay, Miami, Austin, Orlando. If you're a buyer, you're in position for better negotiation. Okay, New York now, Jacksonville, Tampa, and Riverside, California. Okay. Highest months of supply, you've got Miami coming in at 9.7. That's real negotiating power for buyers. Austin at 7.1. They've been in a buyer's market for months now. Orlando 6.9, New York 6.7, Jacksonville 6.3, Tampa 6.3, Riverside 6.1. Balanced metros near the national average. LA, Denver, Portland, all coming in at 5. Lowest months of supply, Milwaukee at 2.7, St. Louis 2.9. Grand Rapids, Michigan, 2.9. Boston in at 3. And I'm surprised to see. Let's pick out some more here. Here's the top 50 metros. Oh, this is out of the top 50 metros. I was going to say I was surprised to see not more of these Northeast numbers in, knowing where inventory is there. But we're looking at the top 50 metros. Chicago coming in on months of supply at, where are they at? 3.7. Okay. Chicago's been one of those lower inventory markets. Just picking out a few others here. You've got, okay, again, Miami at 9.7. You got Minneapolis low at 3.8. Nashville's at 5.8, just above the national average. New York, again, at 6.7. And San Antonio at 5.3. So there's been a little bit of a recovery there in terms of inventory in San Antonio. Phoenix, which is one of those markets you always are looking at as an indicator, 5.2. So right there at that national average in Phoenix. Washington, D.C., which has been in the headlines a lot, 4.1. So actually, leaning closer towards a seller's market than it is an equal market at the low range of that 4 to 6 months, according to this Realtor.com report there. Inventory of homes did grow for the 22nd straight month. Supply recovery has slowed. Remember, August, we actually saw the drop in supply, and prices are remaining flat. This 7 buyers markets nationally, there's 20 sellers markets and then 23 balanced. So you have a bifurcation across the country. Understand, obviously, where you are. And if you think you're tracking towards some other market right now, maybe you're seeing signals that you saw in a Miami from 3-4 months ago happening in your market, then it might be a good idea to draw those comparisons. Okay. Inventory right now growing the fastest in the West and the South, followed by the Midwest and then the Northeast in that order. Of the 50 largest markets recorded year-over-year inventory growth, DC, Vegas, and Raleigh saw the sharpest increases, where the greatest inventory relative to their pre-pandemic levels. You got Denver, San Antonio, and Austin. And then the 3 that have recovered the least in terms of inventory, it's Hartford and Chicago and Providence. Look at Hartford, still at 75% below inventory. So when you look at it, what's the future look like if you don't build any homes? Look no further than, say, a Hartford, Connecticut there. Okay. All right. I'll put the rest of that data there if you want that in inside of the hot sheet inside of the hot sheet classroom on School, including this one here, the delistings, which have surged. This one tells me seller, for everybody that says, oh, buyers are waiting for the crash, they're waiting for things to really shake out in their favor. Sellers are saying, not so fast. We'll just take the home off the market. Delistings surge and new listings fade. We're not interested in a new listing, and we're not interested in keeping our home on the market. One home delisted for every 1.75 new listings in Miami. You're seeing that surge happen there. You're seeing it in Phoenix. Okay. One of the things keeping these months of inventory down in the equilibrium, Phoenix at 5, is that I just won't sell my house. I don't have to sell it. I either 4 out of 10 homeowners don't have a mortgage, or I'm at 2, 3, 4%. What do I care? I'll keep the property. It's a better asset for me than giving somebody a discount. Okay. One home delisted for every 3 new listings happening in Tucson, Denver, Tampa. And then one home delisted for every 10 new listings. The other side of the equation, that's Milwaukee and Hartford, where you have this lower level of inventory. All of the data that I use here on the hot sheet every single day, I drop into School for BAMX members, school.com/BAMX, the #1 agent community to close more deals. Not only do you get your new content drops every single week from the BAM team, but here inside the hot sheet classroom, I'm delivering all of the charts that I'm using here on this show. each and every single day, including this delisting surge chart that we just looked at, as well as all of the show notes. All right, let's jump in now to the report here for the week on mortgage applications. Mortgage applications, according to Mortgage Banker Association, come in at 9.2% higher from the week earlier. That's the headline number. This result includes the adjustment for the Labor Day holiday. It also includes more year-to-date lows on this number. The real number that we care about, if you're dealing with home buyers and home sellers, particularly as a real estate professional, is going to be the purchase index, which increased 7% from 1 week earlier. That's a significant pop at a time of year when you could see flat numbers as an expectation or even a decline in number. 7% pop week over week on the purchase side is a real number, and it's a big number. 23% is the number for the same week a year ago. So we continue to see double-digit gains year over year. Future looking pretty bright there as it relates to mortgage applications. We're still well off of normal times as it relates to applications, but consistency matters, and we're getting better every single week. Mortgage Banker Association President, Deputy Chief Economist Joel Kahn acknowledged this with rates decline for the second consecutive week. Treasury yields moved lower on data indicating that the labor market is weakening. The 30-year fixed decrease is just reflective of the 6.49 year-to-date low. So next week, when we get a 6.29, 6.28 year-to-date low, we'll be looking even closer out of a holiday week on mortgage applications, and the biggest one-day drop on the rates. We'll see if this number can finally pop and get off of what we are seeing as like the bottom of the barrel line. That we haven't been this low overall on mortgage bank on MBA's purchase application index since the Great Financial Recovery and since the 1995 era. So looking for more consecutive pops to get this kind of off that Mendoza line, if you will. All right, 10-year coming in right now at 4.063 to start the day. This is kind of where it's been hovering here for the week. Since we saw that jobs report on Friday, it's been down in this range under 4.1. That has created a year-to-date low for 3 now consecutive dates, 6.29 on Friday, Monday, Tuesday, 628, 629. And this is what, this week, when we look back next week on mortgage applications, this week will be reflective of these numbers. I don't see these numbers changing today with the news that we have at hand. The markets so far here today, with this PPI news being good month over month, are really kind of really unchanged. Dow's unchanged. The S&P rises to another new record. Look at that on new inflation data. And then NASDAQ, which also saw a new record. Listen, the markets they are not fearful of a recession. The Dow, the S&P, the NASDAQ, multiple all-time high after all-time high here in recent months. So the markets have now come around on trade deals. They like the new underwriting of the financial system that the administration is trying to shape right now. They're in an alignment with that. They're in alignment with how 2026 looks, and they can be wrong. Markets can be wrong, but right now they don't see big concerns for a recession. They actually see and are pricing in the Fed having to take action here and cut. And obviously we'll hear from the Fed next week. In fact, in 7 days, and CME Group says 91% chance that it'll only be a 25 basis point cut versus a 50 basis point cut. Poly market has it a little bit differently. The betting market has 17% chance that you will see a 50 basis point cut versus an 81% chance that it will be only a 25 basis point cut. Okay. Today, 3 p.m. Eastern, how to dominate Google and AI search. Free webinar. Myself, Scott Harris, CEO of experience.com. We're going to be doing live audits. Okay. Live search ranking audits. How do you rank on Google? And how does that support AI crawlers so that when someone asks chat or another AI, hey, who should I be reaching out to for my buying, selling, investing needs, that you're popping? Okay. How to dominate this Google search and AI search. We're doing live search rankings today, 3 p.m. Eastern. Join the Zoom. Link down below. Myself, Scott Harris, experience.com. Join the Zoom today, 3 p.m. Eastern, 12 o'clock on the West Coast. You know the deal in between. I will see you later today at 3 or noon Pacific time. Until then, toodaloo.